an order block is. The most refined definition of an order block I could find is this one. The candle that dips above a high or dips below a low, then gets engulfed, is considered an order block. In this image here, you can see this low. What happened here is that price came down to this low and took out that low. For an order block to be considered valid, it must follow a turtle soup formation. If there's no turtle soup, the order block won't be considered correct. Now here you can see the exact candle that dips below this low. This means we're waiting for this candle to be engulfed. By engulfed, I mean that the price must close above it. Once the price closes above, it will become a valid order block for us. Here, you can see the price closing above that candle, forming this thick down close candle that now becomes an order block. After that, we wait for the price to retest this order block, find support there, and then expand from that level. This is what we refer to as an order block. Once an order block is tested, the price is likely to expand from there and take out the opposing end of the range. Now let's discuss breaker blocks. The definition of a breaker block is a high that takes out a low, or a low that takes out a high. When it's broken and retested, it's considered a breaker block. In terms of key levels, a breaker block is mid-range in terms of significance, but it's an important key level that you can use on higher time frames. Here, you can see we have this high and this low. What happened is that this high took out and turtle souped this low, and then it broke above afterward, becoming a breaker block. Next, we wait for it to be retested, find support, and expand from there. You can also reverse this to see how a bearish breaker or bearish order block would look. Now, let's talk about an FVG. One thing to remember is that if you understand turtle soup, then all these key levels become much easier to grasp. We've already covered order blocks and breaker blocks, and as you saw, the only reason they were considered valid and correct is that they followed a turtle soup formation. Even an FVG, at its core, is simply a lower time frame turtle soup. If you observe a higher time frame FVG on a lower time frame, it will essentially look like a turtle soup, as I mentioned. The definition of an FVG is a price gap between consecutive candles, indicating an imbalance in price action. But, as stated before, it's basically a lower time frame turtle soup and retracement profile. Now, moving on to the most crucial key levels, highs and lows. Highs and lows are top-tier key levels, and if you examine charts, you'll see that most expansions and reversals occur around significant highs and lows. They are fundamental elements that drive market movements. In a reversal profile, price sweeps above a high and reverses immediately. Similarly, during expansion, price initially takes out a low or a high, gathers liquidity, and then continues. Now let's move on to another slide. Here we have a chart, and on this chart, we'll break down the anatomy of a price swing. This is the basic movement of the market. While it might not appear as smooth in real time, this is essentially how the phases of a price swing work on an objective and mechanical level. We also call this sequence the TSQ, or the sequence of a price swing. A price swing begins when the price takes out a significant low or high. In this case, we have this low here, and the price has souped that low with this candle. Based on the definition of an order block, when this candle is engulfed, it becomes an order block. You can see the price close above the candle that dipped below the low, marking it as a valid order block. After that, the price retests and expands from there. Similarly, when the price closes above the high that broke the low, it becomes a breaker block. The price then tests this breaker block, finds support, and expands, continuing the price swing. A price swing ends with a turtle soup, so the swing both starts and ends with a turtle soup formation. This mechanism repeats, giving rise to new swings. This is how the market ideally moves in swings, and while variations exist, the core concept remains consistent. Now we'll combine key levels with market profiles and explore how to use them in a live market. This approach allows us to apply specific logic to anticipate market behavior, helping us make more informed trading decisions based on different profile scenarios. By integrating key levels with market profiles, we can identify the most effective trading setups and recognize potential shifts in market direction. Now let's talk about the combination of a ranging market profile and key levels. The first combination we're looking at is when a ranging market profile aligns with key levels. Keep in mind that this line here represents key levels on the higher time frame. When you see this line, it's indicating a high time frame key level. There are only two possible outcomes with this combination. The first scenario is when price forms a range, but that range ends without testing any key level. The key level could be an order block, a breaker block, or even a high or low. When this happens, we expect a manipulation profile to form. This manipulation profile will be responsible for testing that key level. Once it does, we'll wait for the manipulation to end, and afterward, we'll anticipate an expansion profile in the opposite direction. The second scenario is when price forms a range within an already tested key level. Here, the key level has already been hit inside the range itself, so we don't need a manipulation profile to occur. We expect the market to move straight into an expansion profile after the range. In both cases, we're using logic rather than simply pattern trading. We're saying, if this, then that. This logical approach allows us to interpret market moves accurately. Next, let's discuss the combination of expansion profiles and key levels. In this combination, we're again layering on the concept of key levels, specifically in relation to the expansion profile. If an expansion profile ends inside a key level, that key level acts as a catalyst for a reversal. So, in this case, we'd expect a reversal profile straight away, as the key level has already been tested. If the expansion ends without testing any key levels, we can't expect a reversal profile right away. Instead, we'll anticipate either a retracement or a ranging profile. Once we enter a ranging profile without testing the key level, we're going to expect a manipulation profile to test that level, followed by an expansion profile. This way, we're filtering our understanding to expect a specific outcome. Previously, we might have expected 3 possible outcomes after an expansion, but now we're reducing it to 1 based on market profiling combined with key levels. Now, let's go over the combination of reversal profiles and key levels. With reversal profiles, we might have 2 key levels, one above and one below the price. In this first scenario, we were inside a range and had an expansion profile that tested a key level. As a result, we can anticipate a reversal profile to form. Once that reversal ends inside a key level, we then expect a range to form, capping the price movement. If a reversal ends without touching a key level, then we expect a retracement profile to form, as drawn liquidity is still in play. This retracement profile will eventually target the key level above, creating the possibility for an expansion after. Using market profiles and key levels together acts as a filter, helping us expect certain outcomes while avoiding others. We focus on trading expansions and reversals, as these profiles offer the most accurate price swings, while avoiding retracement, manipulation, and ranging profiles. For example, after a manipulation profile, we can trade the next profile because we know an expansion will likely follow a manipulation profile. After an expansion profile ends inside a key, let's move to the next section, where I'll provide a structured framework on time frame selection for integrating market profiles with key levels. It's essential to know that we won't be using the same time frame for both concepts. Instead, we'll use a higher time frame to identify key levels and a lower time frame for market profiling. If you're an intraday trader, you'll use the 4-hour time frame to find key levels and the 15-minute time frame for profiling the market. Similarly, for scalping, the 15-minute time frame will be used for identifying key levels, while the 1-minute time frame is for profiling. This framework enables us to integrate key levels with market profiles logically and efficiently.